Oil's prices were on the rise since our last report, a bullish tendency which intensified on Tuesday given the missile attack of Iran on Israel. In today's report, we have a look at the state of the US oil market, the situation in the Middle East, the demand side of the international market, and OPEC's ministerial meeting. The report is to be concluded with a technical analysis of WTI's daily chart. There were mixed signals from the US oil market in the past few days, who make us start by noting that the Baker Hughes oil rig count last Friday showed that the number of active oil rigs in the US dropped by 4, reaching 484. The release tended to imply a slack of the US oil market, as shutting down of 4 active oil rigs may have been caused by reduced demand. On Tuesday, we got the AP weekly crude oil inventories figure, which showed a narrow drawdown, while EIA on Wednesday reported a considerable increase of US oil inventories, implying that oil production surpassed oil demand in the US, implying a slack in the US oil market, which could be perceived as a bearish signal for oil prices. Should we see clearer signs of a slack in the US oil market, we may see an adverse effect for oil prices in the coming week. Iran's missile attack on Israel on Tuesday may have been the main factor behind Tuesday's strong bullish movement in oil prices. The Iranian attack included a high number of missiles fired at military targets in Israel and had minimal casualties. Yet Israel is expected now to strike back, and the question looms how hard it will strike back. Iran's nuclear energy facilities are a possible target, yet the US have warned Israel not to hit such sites. Another possible target that is directly linked to the international market could be Khark Island. The island is Iran's main oil exporting hub, and should it be hit by the Israelis, it could create a massive rally for oil prices as market worries for a possible shortage of oil supply in the international oil market could emerge. On the flip side, a softer retaliation by Israel could calm the market's nerves and allow for oil prices to correct lower. The other factor in play over the past few days has been OPEC's ministerial meeting yesterday. The organization, in its press release, emphasized the critical importance of achieving full conformity and compensation in a sign of oil production tightening. Yet, according to Reuters, OPEC has enough spare oil capacity to compensate for a full loss of Iranian supply if Israel knocks out that country's facilities, but the producer group would struggle if Iran retaliates by hitting installations of its Gulf neighbors. It should be noted that Iranian exports of oil played an increasingly important role in the international market in the past year, despite US sanctions. Overall, we see the case for OPEC to have a bullish role in regards to oil prices, yet discussions for a possible easing of oil production cuts by Saudi Arabia had in the recent past allowed for oil prices to drop. WTI's price action has been on the rise since our last report and is currently testing the 71.15 resistance line. It should be noted that the RSI indicator remains stuck at the reading of 50, implying a relative indecisiveness on behalf of market participants for black gold's price direction. We see the case for further bullish tendencies, yet remain rather cautious, maintaining a sideways motion bias for the time being. For a bullish outlook, we would require the commodity's price to break above the 71.15 resistance line clearly, and aim, if not reach, the 75.5 resistance level. Should the bears take over, we expect WTI's price to relent the gains made in the past few days, break the 68 support line, thus opening the gates for the 64.70 support base. We hope that you found this report useful, and from all of us here at IronFX, best wishes.